Right now, homebuyers are looking at fixed mortgage rates hovering near 6.5%. Combine that with stringent lending standards, and we have a deeply frozen housing market. To thaw it out, Congress negotiated a 381-page legislative package known as the 21st Century Road to Housing Act. To get the bill moving, House Financial Services Chair French Hill pushed through a major compromise, deregulating small banks to get them back into lending. This creates a direct choice for those looking to buy. It forces a comparison between the immediate savings on a monthly payment and the long-term stability of the financial rules that were put in place after 2008. By linking housing affordability to banking rules, the bill asks the average homebuyer to participate in a broader shift in how the government manages financial risk. To understand why we are pulling back on bank rules, we have to look at the fallout from the Great Recession. In 2008, standard banks originated 60% of mortgages and held 95% of servicing rights. Strict Dodd-Frank and Basel III compliance overhead forced banks to step away. Tech-driven non-bank lenders filled the void, and by 2023, standard bank origination plummeted to 35%. Standard community banks simply do not have the armies of compliance officers or the scale needed to compete in that environment. This new housing bill is specifically designed to change that math. The first hurdle the bill targets is compliance overhead. Processing a loan application today requires verifying a mountain of data against federal safety standards. This table breaks down how the new bill alters overhead, reducing how often community banks face rigorous federal examinations. For consumers, this drops loan origination costs, allowing local banks to offer competitive rates. However, this requires trusting banks to police themselves and avoid bad loans. We have seen what happens when that internal discipline fails. Relaxed oversight was a primary driver of toxic lending that forced millions of homes into foreclosure in 2008. While these cuts make local mortgages cheaper to process, they dismantle the exact early warning systems designed to alert us before a market fails. The second target is capital reserve requirements. These are the mandatory safety buffers banks must keep in the vault to ensure they can survive an economic shock. The bill alters how banks define certain funds on their balance sheets, specifically brokered deposits, which are aggregated from investors and distributed to the banks. It also includes provisions like reducing the Federal Reserve Bank's surplus fund cap by $115 million. As the table shows, reducing capital reserves frees millions of dollars from vaults, injecting them into local construction and lending. But that liquidity has a strict systemic cost. Thinning the financial buffer limits the system's ability to absorb sudden economic shocks. Freeing vault capital trades catastrophic macroeconomic insurance for everyday consumer liquidity. The bill also includes a push to authorize new bank startups, known as de novo banks, which have been rare since the last crash, especially in rural areas. Bringing localized competition into underserved areas naturally pressures existing lenders to drive down their mortgage rates. Local community banks also rely more heavily on human underwriting. This means if you have a non-traditional credit file, a local banker can look at your specific situation and approve a loan that an algorithm would reject. Adding de novo startups to our table highlights the final trade-off. We get lower rates and higher approvals, but we distribute risk across hundreds of smaller institutions that lack the balance sheets of megabanks. A decentralized, localized banking network creates better consumer access. It also increases vulnerability to regional economic shocks. With these new rules shifting the mortgage market, you have to adjust how you shop for a loan. This flowchart outlines how to navigate the new mortgage market, starting with your specific credit and income profile. If you are self-employed or have a complex income stream, your best path under the new law is routing to a local community bank or credit union to take advantage of their restored flexibility. On the other hand, if you have a standard W-2 income and need fast digital approval, you will likely find the most efficient processing through a non-bank tech lender. Understanding the specific regulatory advantages of each institution allows you to target the right lender, avoid unnecessary rejections, and secure the best rate. This entire legislative package is a calculated risk, engineered to unfreeze a stagnant housing market. In the short term, access-starved buyers will benefit. Expect local credit unions and community banks to aggressively market new, slightly cheaper mortgage products. For those monitoring the broader economy, the calculation is visible. The system is trading a portion of its safety buffer for increased market fluidity. The core burden of risk is moving away from the individual borrower's immediate monthly payment and onto the balance sheets of the broader financial system. You should take advantage of the incoming rate competition to get into a home. Just remain vigilant about the systemic health of the institutions holding your primary deposits.